Hello, and welcome back to yet another live event where we unpack apartment investing, passive investing, underwriting, due diligence, one step at a time. So, I do want to talk about a time when LPs stopped vetting deals and started getting in line. But before we dive in, for those who may be tuning in for the first time, my name is Vessi Kapuyan. I'm a former commercial lender, spent most of my career in underwriting, risk management, and now I run my own firm focusing on advisory and investment services. On the advisory side, I help private investors, family offices with the due diligence process, being a second set of eyes on deals and investment opportunities that they're evaluating, particularly in the apartment space. And then on the family office, family enterprise side, I typically get engaged at the board director, board advisor level, depending on how much engagement the company needs and wants at that point of time. So I had a post earlier this week. Over the next 15 days, I will be sharing lessons from the last cycle. So 15 days, 15 lessons. And the big one will actually come on July 11th. So mark your calendars for July 11th at 11 p.m. But I do want to talk about the LP side of diligence today is because it seemed like, especially in the 2020s, early 2020s, 2021, even the first part of 2022, LPs were not really vetting deals, but rather getting in line in order to get into a deal. And that pattern was consistent across different markets. Just say a sponsor would open a raise, the allocation would fill in days, sometimes hours. I remember we had a deal that filled over a weekend, about 48 hours. And so returning investors effectively had to wait in line for the next deal, and they waited for their turn, which created a lot of FOMO, fear of missing out. And at that time, I even remember some passive investors would even write a check before reading the offering memo because they had already missed on the last two raises and really didn't want to miss on yet another great deal. With that said, a lot has changed over the last almost 5 years at this point, and the investor lens has inverted. The questions are no longer, is this deal worth my capital? The question at that point of time was, will I be allowed to invest in this deal? And today, investors are asking a different question. But at the time, thinking about it that way, is it worth? Is it not asking the question of is it worth my capital, but instead thinking, will I even be able to invest in the deal? Is a very dangerous position to be in, or think from when evaluating these investments, because um, capital deployment is supposed to flow from diligence, and when diligence flows from the scarcity of the access instead, then the order of that thought process and operations can lead to a lot of painful mistakes. And that also reminds me of a saying that I once heard Howard Marks mention, right? Is the biggest risk of all is to think that there is no risk, and it's a lot uh, better to miss on an amazing deal. And I'm not necessarily quoting him directly, but sort of paraphrasing, is the biggest risk is not to miss on an amazing deal, but to get into a really bad one. And so I remember at the times the PPMs were skimmed, not read, operating agreements were not even open. And sadly, even recently, I had someone mention, oh, I didn't even know that clause was in the operating agreement. And mind you, that was coming from someone on the management team who had partnered with a certain group. And so, similarly, sponsored track records were checked at the surface. They were looking at the combined years in business, overall average returns, but those were not really stress tested or peeled further to determine, well, what did the work? Was it the market, or meaning cap rate compression, or was it true operations and executions? And so, um, it is not surprising then that a lot of these deals, unfortunately, ended in situations where capital calls emerged, distributions were paused, and we've been hearing more and more about deals that are getting foreclosed on and taken back by the lender. The debt structure were also not fully understood or asked about, right? The debt tail was wagging the deal, meaning a lot of folks were getting into high leverage variable rate loans because that was the only way to make the numbers appealing on paper, and what really allowed many sponsors at the time to overbid and overpay. Reserve assumptions is another factor that those rarely came up or were into question. And at the time, I felt like there was a moment of a rush, right? The justification was that there was not enough time. If you weren't fast enough, you would lose on the deal, or the allocation would close and people will move forward without you. And yes, that justification protected those, definitely those um, who were selling the deals, and in some cases some sponsors who really benefited from that fear of missing out. And that created a lot of pressure and stress for LP. And so, um, the discipline worth recovering as you reflect on that and think of the cycle today is the willingness to actually lose access to the deal, the willingness to be the investor who says, I'm not ready to commit to this round. Send me the next deal you have. I need more time. And the investor who says no twice is typically taken more seriously on the third opportunity than the investor who said yes too quickly without really giving it much thought the first time, at least for the sponsors who are selective, who they work with, right? And so I want to leave you with the question, when was the last time you said no to a deal that you could have been in, maybe one that was under timing pressure? And if that hasn't happened, maybe think about the last deal you did, or maybe the last two deals you did, and would you do anything differently knowing what you know now? This series of the various lessons learned will actually continue tomorrow. I'll be doing a series of posts, videos, live events, articles. I will be sharing something that I've been working on for a very long time to namely help investors recognize these patterns and take these lessons so they can be educated and empowered in their investing journey. So, again, mark your calendars for July 11th at 11 a.m. Pacific time. And as always, I appreciate your engagement and tuning into those live events. If you have any comments, you can either, or questions, feel free to message me directly for one-on-one interaction, or you are welcome to share those in the comment section. I will keep these pop-up lives coming, so I'll see you next week. Usually I come in every Thursday or Friday afternoon around between noon and 2 Pacific. And if you'd like to be notified of those events or any other complimentary content that I share, please follow me on YouTube and LinkedIn so you can be notified and don't miss out. So I wish you a blessed day, and I will see you next week. Ciao.